today was a bad day for the stock market, but in just about every single metric right now, you guys, in just about every single metric, the market is massively overvalued. I mean, literally, it's the everything bubble. And, whether it be the Buffett indicator, where the stock market grows faster than the economy, basically what we're seeing right now. Currently, the Buffett indicator is at 206, which is 142% above its long-term average of 85, going back to 1971. You can talk about the price to sales ratio on the S&P 500. It's basically saying that it's the most overvalued market relative to its total sales maybe ever. I mean, it goes way back. And when you talk about the insider selling, it's 6-1 right now. You have 6 insider sales for every 1 insider purchase. And that's not a good thing. Jeff Bezos has already sold, just in this year alone, 12.5 billion worth of Amazon. Just last week, he did 1.25 billion. Zuckerberg is up to 2.4 billion. Last week, 153 million more of Meta stock. And the insiders with NVIDIA have sold almost 2 billion year to date. And so as corporate execs are cashing out, individual investors have never been more bullish. In fact, recent poll says 46% of investors see a 10% less chance of a market crash. And this is the highest percentage since 2006. So yeah, I mean, it's ominous for sure to see the insiders bailing and the market at all-time high valuations, the euphoria surrounding the Trump risk-on trade. And at the same time, the insiders are quietly tiptoeing out the exits in the middle of this party with all the streamers and confetti going up in the air. They're doing the Irish goodbye. And so I think that's something people should be paying close attention to as we get close to the end of the year here. I think in the end, guys, metals are going to go a whole hell of a lot higher. This was something I think that we should have expected. This is a market where we had massive short positions in London and in the US by the commercial banks that were hugely underwater. And I think they used this optimism as an opportunity to right their balance sheet and to push silver below $30. It was, this is what they've been trying to do. And I think you'll see it turn right back around because all of those short positions get covered and it goes right back around. What you will see is massive managed money selling and commercial banks taking the other side of that and going long. This is an environment where, to me, this is as big of an opportunity as I think you'll ever find in precious metals because nothing has changed whatsoever. Nothing has changed. And the commercial banks and the bullion banks and the central banks are doubling down what they're buying. They're doubling down their efforts and they are using the stupidity of the Western suppression of the paper markets to do just that. So I would say that this should have been expected, maybe not as severe as we thought. But I do think that for the most part, if I had to bet, the worst of the drop is behind us now that we've broken below these numbers. Those short positions will have been covered, and I think you'll see the market turn up from here.
The market, across virtually every metric, is revealing a glaring truth. We're in the everything bubble. From the Buffett indicator showing a massive overvaluation of the stock market compared to the economy, to insider sales outpacing purchases by a staggering 6-1, the cracks are widening, and those who understand the signs know where to pivot: gold and silver. Let's set the stage. The Buffett indicator, currently sitting at 206%, is 142% above its long-term average of 85 since 1971. That's not just concerning, it's a red flag waving in the face of anyone still clinging to the idea that this market has legs to stand on. The price-to-sales ratio on the S&P 500 underscores this, revealing that stocks are trading at historic premiums relative to their sales. It's no wonder insiders like Jeff Bezos and Mark Zuckerberg are cashing out billions of dollars in shares, because they know the music is about to stop. Yet, amid the confetti of market highs and the Irish goodbyes of insiders quietly exiting, the real opportunity lies elsewhere. The precious metals market, particularly gold and silver, is poised for an explosive revaluation. Why? Because nothing has fundamentally changed. Let me break it down. The market for precious metals, especially in silver, has been underpinned by a systematic suppression through short positions held by commercial banks. These institutions have been underwater for years, leveraging paper contracts to artificially depress prices. But here's the kicker: this strategy is unsustainable. In London and the US, commercial banks with massive short positions have been scrambling to cover as the cracks in their facade begin to show. These institutions seized on optimism in the broader market to temporarily balance their books, pushing gold and silver prices down. But savvy investors recognize this for what it is, a buying opportunity. The fundamentals are rock solid. Central banks, especially in countries like China and Russia, have doubled down on their acquisitions of physical gold. They're not buying ETFs or paper contracts. They're accumulating the real thing. Why? Because they understand that fiat currencies are losing purchasing power at an accelerating pace. Inflation is eating away at savings, and global debt levels have reached unsustainable heights. What's happening behind the scenes is nothing short of a financial chess match. Eastern nations led by China have been methodically draining the West's reserves. They've been standing for delivery on physical metals contracts at the LBMA, London Bullion Market Association, and COMEX, Commodity Exchange, slowly but steadily. Unlike the West, which has relied on a fractional reserve system in metals, the East is playing the long game. Countries like China are not rushing to trigger a market collapse. Why blow up the game when you can win it methodically? By accumulating metals at suppressed prices, they're building reserves while simultaneously undermining Western financial dominance. In 2020, this trend became glaringly obvious as countries began taking delivery of physical metals instead of rolling over contracts. The silver market in particular tells a fascinating story. London faces a 4 to 6 billion ounce shortfall, while COMEX has between 700 to 750 million ounces in naked shorts. Most of these positions are backed by nothing but large checkbooks. This is a house of cards waiting for the right gust of wind to bring it all down. What's driving this? At its core, this is financial warfare. The so-called tariffs imposed by the US are not tariffs, they're sanctions. These measures are pushing nations further away from the dollar and toward alternative systems. The BRICS nations, Brazil, Russia, India, China, and South Africa, are leading this charge, looking to de-dollarize their economies and strengthen their monetary positions with gold and silver. Here's the irony. The West is selling its gold and silver reserves at stupid prices to fund short-term financial tricks. Meanwhile, the East is quietly accumulating these metals, understanding their long-term value. The LBMA's silver stockpile, for instance, is declining at a 45-degree angle. This isn't a temporary trend. It's a strategic play to render Western systems like the COMEX obsolete. As we close this first half, let's take a step back. The signs are everywhere. The Buffett indicator, insider sales, central bank purchases, and Eastern accumulation all point to the same conclusion. Gold and silver are not just assets, they're necessities. The West's financial systems are built on a shaky foundation of debt and leverage, while the East is constructing a fortress of tangible value. For those paying attention, this is the moment to act. The market might be partying like it's 1999, but the smart money knows where the real value lies: gold and silver.
In silver than it is in gold. And if you look at the stockpiles of the metals that are being held at the LBMA, at the COMEX, and even at the Shanghai Metals Exchange, they are drawing straight down. And what's different now over the last few years, and I would say it started really in 2020, than any time that people have been following this market. And look, I go back to 1990 following this market. That's when I started in this industry. For my entire career, no one stood for delivery. Never. I mean, less than 1% of the contracts did. But this is what's different now, and these countries are smart enough to be methodical about it. So they're standing for delivery. They're draining the LBMA, they're draining the COMEX very slowly, very methodically. If you do it too fast, you get a force majeure, you get some sort of a default and the whole thing blows up. You cut off your nose to spite your face. Instead, they play the game with the West. And the game that the West has played is to support the illusion of the strength of the bond market, the strength of the currency. And they never counted on these countries being coordinated, sophisticated, motivated, and wealthy enough to stand for delivery, but also smart enough to do it in a methodical fashion, to not raise the red flag fast enough. But I think in the silver market, look, there's a 4 to 6 billion ounce shortfall in London. 4 to 6 billion. That's why they tried so hard to drive the price down here into the end of the year, closing out the stops, letting their balance sheet kind of level off, and they'll take the other side of that. And there's between 700 and 750 million ounces short on COMEX. Most of this is naked, meaning there's nothing behind it, but a big checkbook. And so they've been able to keep the game going for a long, long time, but it ends when the rest of the world continues to buy metals because they don't want our treasuries anymore. So when you asked me earlier about the, what I consider to be financial warfare, the supposed tariffs, they're not, they're sanctions. This is exactly what will continue to make these countries want to continue to use the Achilles heel of the West against us, the short positions on these commodities and the delivery availability. So look, they have enough money to blow it up all at once, but then the game's over. So they're slowly draining the exchanges, not so fast that the whole game ends, but fast enough to see a massive drawdown. You look at the LBMA stockpile of silver, it's a 45-degree angle, and it's falling in on COMEX too. Gold a little bit slower, but it will happen the same way. And I think what will ultimately happen is that the exchanges in the East will take over for the COMEX and the LBMA. They will be rendered a scam. They will be rendered a fractional reserve system. We're not there yet, but I think that there's no question that they understand what we're doing, and they understand the way to win is to use that leverage against us and to do it in a way that doesn't or allows them to continue to do it as long as possible. That's why they're not bitching. They're not bitching because they understand, but they're the ones accumulating, and we're foolish enough to let it go at stupid prices.
Gold and silver markets are at a historic crossroads. While many in the West remain distracted by inflated tech stocks and speculative trades, the East has strategically positioned itself to reshape the financial order. This story isn't just about metals, it's about sovereignty, strategy, and survival. Let's delve into the implications of this seismic shift and explore why gold and silver are your best tools for navigating the uncertainties ahead. The dichotomy between the East and West in their approach to precious metals is stark. Central banks in Eastern nations are on an acquisition spree, methodically accumulating physical gold and silver. They understand that fiat currencies, including the US dollar, are losing purchasing power at an alarming rate. Meanwhile, the West remains entangled in its web of speculative paper markets, oblivious to the storm brewing on the horizon. China, for instance, has been quietly increasing its gold reserves, often through unreported channels to avoid triggering market alarms. According to Swiss export data, significant amounts of gold have flowed from Western vaults into Chinese hands. Official numbers are likely a fraction of the truth. This isn't just a matter of financial prudence. It's a calculated strategy to reduce reliance on the US dollar while strengthening their currency with tangible assets. Russia, too, has been fortifying its gold reserves, using it as a bulwark against Western sanctions. By leveraging gold, these nations are not just safeguarding their economies, but also laying the groundwork for a new financial architecture. The dollar's weaponization in global trade has made alternatives like gold all the more attractive. Silver, often overshadowed by gold, has its own compelling story. Unlike gold, which is primarily a monetary metal, silver serves dual purposes. It's both an industrial and monetary asset. This duality makes it an essential component in the global economy, particularly as industries like renewable energy and electronics expand. The current gold-to-silver ratio, hovering around 85:1, is a glaring anomaly. Historically, this ratio has been much lower, often around 15:1 during periods of economic instability. What this tells us is that silver is massively undervalued relative to gold, presenting a unique opportunity for investors. But the silver market is under siege. The LBMA and COMEX are grappling with a systemic issue. Their short positions far outweigh their actual physical supply. COMEX alone has 700 to 750 million ounces in naked shorts, contracts backed by nothing but speculative promises. This precarious situation has persisted for years, but the cracks are widening. Eastern nations, alongside private investors, have been systematically draining these reserves by standing for physical delivery. Unlike in the past, when less than 1% of contracts were settled in physical metal, we're now witnessing a growing demand for actual delivery. This shift is a direct challenge to the fractional reserve system that underpins the Western metals market. You might wonder why central banks focus primarily on gold rather than silver. The answer lies in the logistics of central banking. Gold is more efficient as a reserve asset due to its high value-to-weight ratio, making it easier to store and transport. Additionally, gold's liquidity and universal acceptance make it an ideal tool for settling international trade balances. However, this doesn't diminish silver's importance. In fact, silver often outperforms gold during bull markets. As generalist investors enter the precious metal space, the demand for silver tends to skyrocket due to its affordability and perceived volatility. This dynamic creates a cascading effect, driving silver prices higher at a faster rate than gold. While the East is playing the long game, the West is trapped in a speculative frenzy. Insider sales have reached alarming levels, with executives from companies like Amazon and Meta quietly offloading billions in shares. At the same time, individual investors remain euphoric, believing the bull market will never end. But the Buffett indicator, which measures the stock market's valuation relative to GDP, tells a different story. At 206%, it's 142% above its long-term average. This level of overvaluation is unsustainable. When the bubble bursts, and it will, the fallout will be catastrophic for those unprepared. Precious metals offer a safe haven in this scenario. Unlike stocks and bonds, gold and silver are not liabilities of any government or corporation. They don't rely on the solvency of an issuer. This intrinsic value makes them indispensable during times of economic turmoil. What we're witnessing is a paradigm shift. The Western financial system, built on debt and leverage, is being challenged by an Eastern model rooted in tangible assets. The implications are profound. De-dollarization. The dollar's dominance is waning as countries seek alternatives. Gold is emerging as a key component of this new system, a new settlement mechanism. BRICS nations are exploring alternatives to the dollar for trade settlement, further reducing its global influence. A return to tangible assets. As trust in fiat currencies erodes, the demand for physical gold and silver will only grow. As investors, we must adapt to this new reality. The traditional 60-40 portfolio of stocks and bonds is no longer sufficient. Precious metals must play a central role in any diversified strategy. Own physical metals. Avoid paper contracts and ETFs. Physical gold and silver are the ultimate forms of wealth preservation. Diversify globally. Consider international storage options to protect your assets from geopolitical risks. Think beyond the dollar. Explore opportunities in currencies and assets that are less exposed to U.S. economic policies. The year ahead will be pivotal. As fiat currencies continue to lose purchasing power, gold and silver are set for a significant revaluation. This isn't just speculation, it's a mathematical inevitability driven by debt, inflation, and declining trust in traditional financial systems. Imagine a world where central banks double their gold reserves, and silver's industrial demand outpaces supply. Prices won't just rise, they'll surge. But by then, it may be too late for those who hesitated. Gold and silver are not just assets, they're lifelines in a drowning financial system. The East understands this. Central banks understand this. It's time for individual investors to follow suit. The window of opportunity is still open, but it's narrowing. The signs are everywhere. Will you act now, or will you wait for the storm to force your hand? Remember, in a world of fiat illusions, gold and silver are the ultimate truths. Invest wisely and stay ahead of the curve. Let's secure our financial future together.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.